everyone. Today the topic of my lecture is monetary policy. Monetary policy refers to the credit control measures adopted by the central bank of a country. There are two types of instruments of monetary policy, quantitative and qualitative. So today I am going to discuss quantitative instruments which are meant to control the credit supply in the economy. The first instrument is bank rate policy. Bank rate is the minimum lending rate. During inflation, when prices are rising, central bank increases the bank rate so that borrowings from bank reduces being costly. So commercial banks also borrow less from the central bank and as well as the businessmen from the commercial banks. So credit in the economy contracts, which leads to fall in investments. This implies fall in production, which leads to less employment, which leads to fall in income of the people, that is less purchasing power in the hands of the people, resulting in fall in aggregate demand, which finally leads to reduction in prices. So in this way, inflationary pressures are checked, vice versa takes place during deflationary pressures. The second instrument is open market operations. The open market operations are meant to sale and purchase of securities by the central bank. During inflation, the central bank starts selling the securities. But when it sells the securities, the money comes back to the banks and credit contracts, less lendings are there and credit contracts, and which leads to further the same process is repeated and finally it leads to fall in prices. Vice versa takes place in deflationary pressures. The third instrument is change in cash reserve ratio. That is CRR. CRR is the percentage of total deposits of a bank that is required to be kept in the form of reserve fund with RBI. When prices are rising, central bank increases this cash reserve ratio, which implies that banks are required to keep more cash with RBI. So their own resources are reduced and their lendings are reduced. So investments are reduced and thus by the same process finally prices are reduced and controlled. The last is statutory liquidity ratio. SLR, every bank is required to maintain a fixed percentage of its deposit assets in the form of cash or other liquid assets called SLR. For decreasing credit, central bank increases SLR, and for increasing credit, central bank decreases SLR. So this was all about quantitative instruments.